All right, guys, we have to talk. Is the market about to go lower? I keep getting this question. Stas, are stocks going to crash? What's happening? Especially after we got word from Jerome Powell himself that stocks are overvalued. He didn't say it exactly like that, but he said stocks are fairly highly valued, which we have to cover that in this video, go over my thoughts, and just in general cover the stock market, break down the charts, what I'm looking to do, as overall we had a red day today, and maybe more red is coming based on what Powell said. So guys, jam-packed video. Hit the like button, subscribe, join the Patreon for my portfolio updates. That is linked down below. There's also a Discord chat, plus more. Check it out. And now, of course, cheers. Take a sip of your coffee. We have a PM coffee for this video, guys. An evening coffee, if you will. Whatever the heck you want to call it. Because we're going to need it. And now, let's dive into it. So, we had a red day. Dow Jones went down 0.4% today. The S&P went down 0.5%. QQQ, let's see, same as the S&P, down 0.5%, and the Russell went down a leading 1%. As the VIX went up 3.5%, and it closed right under 17. The VIX did. So we had a red day. And I'm not surprised. You guys know we've been covering how the charts were looking pretty overbought. The market was due for a sell-off, and honestly, it was begging for any reason to sell off, and we're finally selling off, right? And it looks like SPY, QQQ, all the indices are coming down to the 180 SMA on the 4-hour chart, which you guys know we've covered this before on these updates, right? So at this point, man, we are approaching a critical support, which has held since the crash back in April for SPY, for QQQ. So this is a big spot in the short term for the bulls, right? You can see here on QQQ, we're approaching 580, 585, right by this moving average. This spot needs to hold. But who knows how much more downside we might get, especially after what Powell said. I don't think we're going to get much more downside, but it's interesting to see kind of where he's at. So let me show you right now. Well, I guess we're not going to play the video of what he said, but we'll go through this article. Then I want to show you guys the Shiller PE, also known as the CAPE ratio, to kind of see, okay, where are we valuation-wise? Is the market overvalued? Let's look at one of the metrics to determine that, which is the Shiller PE. We'll take a look at that in a second, but I want to show you what Powell said, or I guess I'll read what Powell said. He said, well, he said a lot of things, but this is part of the clip. He said, we do look at overall financial conditions, and we ask ourselves whether our policies are affecting financial conditions in a way that is what we're trying to achieve, right? That's not bad. All right, we get that. Then he said, but you're right. By many measures, for example, equity prices are fairly highly valued. You see it right here. Equity prices are fairly highly valued, which I can't remember the last time I've heard him say something, like that. But, he was essentially going on about how the market ebbs and flows. You see certain periods where stocks get a little hot. I think he mentioned, during the pandemic a couple years ago, we saw similar valuations. So, yeah, he said it himself, the head of the Fed. Powell doesn't just mean that stock prices are flirting with record highs. He means that stocks are looking overvalued, a sentiment that sent markets slightly lower. Yeah, we're trading at all-time highs for sure, but you also have to look at different metrics. The Shiller PE, for example, which we'll look at in a second here. That is, pushing overvalued territory. That's the reality. But that's not a reason to not invest. We don't know what's going to happen or how long, we're going to be here. In terms of the market being overvalued, it could go up for another 5-10 years, so it's not a reason not to invest, but it is something worth mentioning. It looks like here Sam Stovall said probably the oldest tenet in investing is buy low, sell high. Yeah, we've heard that, right? He said while a long-term diversified approach is typically recommended for everyday investors, The professionals are also attuned rather to the market cycles. They typically hope to buy when stocks are cheap and sell when they're expensive. Yeah, all right, blah, blah, blah. We all know that. But essentially, man, you can't time it. If you're a long-term investor, yeah, in reality, it's like, yeah, buy low, sell high. Duh. With individual stocks, that makes sense. With ETFs, even that makes sense. But if you're buying an S&P 500 ETF for the long term, trying to time it, buy low, sell high, not a smart strategy. You're better off just buying, holding, buying, holding. This is if you have decades to go, or even 10, 15, 20 years. Well, I guess 20 is decades, right? But if you have a long time horizon, man, don't try and buy low, sell high. Just hold, even when stocks are overvalued or they seem expensive, because like I said, you never know when or how long they're going to be overvalued or how much more the market could go up. So this is the Shiller PE, which I've mentioned before on the channel throughout the history of the channel, guys. What kind of ad is this? How much should you walk to lose 30 pounds? Is this ad telling me something, guys? I don't know what this ad's telling me, but yeah, let's not look at this ad. It says here, the Shiller PE. For those that don't know, you should know, but if you don't know, it's the price to earnings ratio based on the average inflation adjusted earnings from the previous 10 years, also known as the cyclically adjusted PE ratio, the CAPE ratio, or the Shiller PE, or PE10. So essentially it looks at the inflation, the average inflation adjusted PE over the last 10 years, essentially, right? So if we come up here, we can see the max is that it hit 44 back in December of 1999. Do you guys remember what happened in December of 1999 or that time period? Yeah, the dot-com bubble. So if you guys take a look at where we're at on the Shiller PE, the CAPE ratio, well, we are pretty much right at the peak from 99. You know what I mean? We hit 44. Now we're at 39. The PE, the CAPE ratio right now is at 39 as I'm making this video. So again, that doesn't mean we're going to collapse, we're due for a crash, but in terms of PE, average, last 10 years, adjusted for inflation, we are a little hot, let's say, and we did see a drop in the Shiller PE, in 2023. We got down a good amount on it. It came down healthy to a healthier spot, but still, we're at 39. The reality is we are at a pretty high level, and look at where it was in 1929, the Great Depression. It was at 31, the Shiller PE. So we're higher now than where we were back during the Great Depression, which times were different, stocks were different back then, valuations, whatever. That was 100 years ago, but still, interesting to look at. So what do you guys think? What do you guys think? And again, I'm not saying that to be like, oh, don't invest, time to sell, because that's not what I'm doing. So that would be hypocritical. It's not like I'm looking at the Shiller P at 39, Powell said what he said, and I'm like, I'm selling out, I'm done. No, that's not how you invest, guys. That's not the smart way to go about it. But maybe, what a smart way to go about it would be, all right, maybe diversify a little bit. If you're all in on super high growth, super high PE stocks, yeah, this might be a warning sign to you. The fact that the Shiller PE is super high, it might be a sign for you to, maybe get out of some super high PE, high growth, super overvalued stocks. Now might be your chance to maybe not get out completely, but maybe offload a little bit. Take some profits. Don't be scared to take some profits and maybe put some money and some cash, buy, 30-year treasuries or something like that, something more stable, whatever, anything, put it in a high yield savings account. This is how you can kind of de-risk your portfolio a little bit, add some bonds, whatever it may be. So if this corrects, right, let's say we do get a cataclysmic crash in like 6 to 8 or 12 months, 18 months. Let's say we do get a crazy crash because the P is super high. You're better positioned for that. You know what I mean? If you're all in super high PE stocks, right at the turn of the crash, yeah, you're gonna get annihilated, eviscerated. But it kind of depends on how you structure your portfolio, right? Or your life in general. Let's say you could have a super high risk portfolio with super high, PE growth stocks. You could do that by all means, but make sure you have a big emergency fund, a ton of cash, or other investments. You know what I mean? Maybe some real estate. So then you can afford having a more risky stock portfolio. Let's say you have a super risky stock portfolio and you don't have an emergency fund, or you don't have, other investments, you don't have any cash. Yeah, that's a bad spot to be in, So it depends on your situation. It's not a one size fits all, but that's a quick rundown for this video. We didn't go over too many stocks, but that's I guess we didn't have to. That's pretty much it, man. I got exactly what I wanted to get out in this video. So with that being said, let me know your thoughts in the comments, guys, and join the Patreon if you want to keep up with what I'm doing in my portfolio, see what stocks I'm buying, options moves I'm making, trades, everything. That's linked down below on Patreon, or go to stocksurfest.com/Patreon. I'm stuttering on my words. With that being said, yeah, I need some more coffee, clearly. With that being said, cheers. I'll catch you all in the next video.